My name is Adam Myers and I lead the distribution team at Pengana. I'm also the local investment specialist for the Pengana WHEB Sustainable Impact Fund. Thank you for joining us for a very timely fund update in what can only be considered to be a very brutal market environment. I will shortly hand over to Victoria, the Associate Fund Manager, who will briefly remind everybody what the strategy is trying to achieve and how it invests. And she will also explain some of the recent performance as well as portfolio positioning. She will then hand over to Claire, a senior analyst in the team, who will discuss the current energy crisis and some of the implications for our fund. If you have any questions during the webinar, please enter them in the Q&A box, which can be accessed from the icon on your screen, and we will get to as many as possible of those at the end in Q&A. Victoria, over to you.
Hi, everyone. Thank you for dialing in. It's great to be here talking to all of you, and I very much look forward to hopefully meeting some of you in person in the next month when I'm over. So as Adam mentioned, this first quarter has been really quite extraordinary in terms of both the macro backdrop with a move towards levels of inflation that we haven't seen in decades, and the accompanying risk of sustained and meaningful interest rate hikes. And then also in terms of the geopolitical events with the Russian invasion of Ukraine. All of this has resulted in significant volatility in markets and a shift away from growth and into value. These developments have represented a significant headwind for the strategy over the quarter. But I think the key takeaway here is that while this has been one of the toughest quarters, if not the toughest in the last 10 years, we still see huge opportunity in our investment themes and feel very positively about the way that the portfolio is set up. We've been active in positioning the portfolio in those companies that we believe will be well placed for the long term, despite having been hit hard by market sentiment in the short term. So maybe just as a quick reminder for those who are newer to the strategy, we are an impact portfolio focused on companies that derive their growth from sustainability solutions. And that sustainable-led growth is the first pillar of our process. The second is built around quality, and that includes ESG considerations. Finally, we take into account valuation and try to maintain a discipline to ensure we aren't overpaying for those core components of impact, growth, and quality. The portfolio is built around 9 themes, 5 environmental and 4 social. And we require that at least 50% of revenue is coming from products or services which will provide a solution in one of those themes. I think the important thing that differentiates our approach is that we're focused only on solutions. That middle section that you can see on this slide refers to what we call transitioning businesses, and that's quite often the focus of ESG strategies. These are companies that are trying to become more sustainable in the way they do business, but their products and services aren't necessarily addressing a sustainability challenge and don't necessarily have a positive impact. So for example, Unilever has a big focus on sustainability in its operations and supply chain, but ice cream and washing powder aren't really solving any global problems. We invest companies that do provide those solutions. For example, those with solutions in clean energy, like Solar Edge, or within electric vehicle value chain, like APTIV, both of which we'll touch on later. This impact map is how we visualize and bring those elements together, so the fundamental quality and impact. The horizontal axis tells you what a company is delivering in terms of the impact, and the vertical axis is how the company is delivering that in terms of quality and also ESG. Over time, I think there's a desire to shift that portfolio both up and to the right, improving both quality and impact. And hopefully what you'll see later on is the progress we've made in that for this quarter. So what does all of that look like in terms of portfolio positioning? For us, factors are an outcome rather than a target. But intuitively, I think they make sense based on those fundamental characteristics that we're looking for. Quality is a core part of what we do, and so we're typically overweight quality factors like cash flow returns. And part of the underlying philosophy is that intrinsic link between positive impact and the growth drivers of the business. So from that perspective, we're looking for companies with above average growth driven by those secular sustainability trends. And you can see that in the revenue growth of the strategy compared with the index in the chart on the bottom left. And both of those factors have influenced performance over the recent period. Mid-cap has been the real sweet spot for where we're seeing those opportunities, and that's resulted in an overweight in the $2 to $20 billion market cap range and an underweight to the mega caps. And again, as we'll come on to later, this has been an influence on performance in this period. The other notable characteristic is the high active share, and that's driven by the relatively small overlap with the index. So with that background, I'll move on to a review of the most recent quarter. So the most notable development was the Russia-Ukraine war. And this is first and foremost a human tragedy, but it has also had significant economic consequences globally. The conflict is expected to cost around 1% of global GDP in its first full year. And in the chart on the left, you can see that most of that is expected to come through higher commodity prices. From a market perspective, after an initial sell-off, global stock markets actually showed relative calm. So the VIX index, which measures volatility of the market and is shown in the light blue line on the chart on the right, is now back to almost pre-conflict level, indicating a fall in investor anxiety. And that's largely due to the fact that the international exposure of Russia has fallen significantly over time, and it's actually relatively unintegrated within the financial system. The market is broadly assuming that the implications of the war are contained within Europe, and that's meant that the European index has underperformed other regions. In terms of impact on our strategy, we estimate exposure to be less than 1% of portfolio revenue overall, and we have no direct exposure to either Russia or Eastern European companies. The second major influence was inflation. Inflation has been increasing as post-COVID demand put pressure on supply chains, and the war in Ukraine is exacerbating the situation. Russia and Ukraine are major suppliers in a number of commodity markets. Together, they account for about 30% of global exports of wheat and 20% of corn and mineral fertilizers. And so that's hit food price inflation. The conflict has also hit energy prices, particularly natural gas in Europe, where Russia is a major supplier. The combination of those effects has implications for companies who rely on these as input costs, but it also has potential knock-on effects for consumer demand. Demand has been relatively resilient in the post-COVID recovery, but higher energy and food prices, as well as potentially more expensive consumer goods in other areas, may hamper demand. As well as that, interest rates have also started going up in order to try to tame inflation, but that's another potential headwind to consumer confidence. One of the trends that we've seen in our portfolio that has helped protect companies from the effects of inflation has been their ability to pass on cost inflation through higher prices. And that to us is an indication of their quality and competitive position. One of the reasons for inflation has been the supply chain disruptions. And in what may now start to sound like a recurring theme, the war in Ukraine has accentuated that issue. And this is particularly true in the semiconductor and automotive sectors. Russia and Ukraine are major global suppliers of inert gases such as neon, which are used in the production of semiconductors. Ukraine also accounts for about a fifth of Europe's supply of wire harnesses for car manufacturing. These are bespoke components, so delays create a huge logistical challenge for car manufacturers. Car manufacturers are struggling with the shortage of both auto components and semiconductor chips, and that's particularly because of the increasing electrification of vehicles. So the major themes have been supply chain disruption, inflation, and the prospect of rising interest rates, as well as risks to demand from the Ukraine situation. So I'll move on to see how that's affected performance. And this slide shows our performance compared with two benchmarks, MSCI World and IA Global. We underperformed both during the period as a result of the challenging environment, and most of that underperformance came in January. It's worth emphasizing at this stage that as disappointing as the numbers are, when we look at the backdrop I've just outlined, I think the underperformance is in line with what we'd expect, given the characteristics of the fund and the nature of the strategy itself. And in the next few slides, I'll try to unpack that a little further. I think that one of the major things to highlight is that in this period, we saw sharp style rotation away from growth and into value, especially in the first 2 months of the year. And that was largely due to the expectation of higher interest rates. In a rising rate environment, growth stocks typically see their valuations come down more than value stocks, because of the long-term duration of their earnings growth. This style rotation, or the beginning of it, was a headwind for us in 2021, as the strategy is more growth-oriented, but the impact was even stronger in this quarter. Similarly, our overweight to mid-cap companies was also a headwind for us, as large cap outperformed mid-cap during the period. The thematic attribution further illustrates how inflationary pressures, supply chain disruption, and that rotation combined as material headwinds to performance in the quarter, accentuating again what was already a trend in 2021. These headwinds were particularly prominent in the resource efficiency and sustainable transport themes, where most of our industrial companies sit. And the Ukraine war has added additional pressure to the auto sector, as we outlined earlier. Health turned from a positive last year to a negative contributor this quarter. And although some areas of healthcare in the benchmark tend to be more defensive, things like the high-yielding pharma stocks, we have more exposure to life science tools companies, which saw sentiment become more negative this quarter, after the company had been very strong COVID beneficiaries. On the positive side, cleaner energy performed well as higher energy prices have increased interest in renewables. In particular, Europe is accelerating its renewable energy targets to reduce reliance on Russian gas, which Claire will talk about a little bit more later on. Education also performed well. We have only one holding in the theme, which is Grand Canyon Education, and it's seen more as a defensive play because it isn't as exposed to the big macro headwinds. The next couple of slides are there to give some examples, some stock examples to help illustrate how those headwinds are affecting the holdings. But more importantly, I think, the reasons why we still have conviction in those companies in the long term. KION is the first example, as it was the biggest negative contributor in the resource efficiency theme. It provides logistics solutions in warehouses, including forklift trucks and automation technologies, both of which help improve logistics efficiency. During the pandemic, it saw a surge in demand for its warehouse automation solutions, as the pandemic highlighted the vulnerability of the global supply chain. However, in recent months, those accelerating supply chain disruptions and higher procurement costs have put pressure on KION's margins, and the conflict in Ukraine has added significant uncertainty about the outlook of industrial end markets. As a result, the company recently withdrew its full-year guidance, which followed a similar move from a key competitor. While the near-term environment remains uncertain, we believe the long-term drivers are strengthened, as the supply chain issues have highlighted the need for greater investment in automation and efficiency. Those structural drivers remain intact and are reflected in the strong order book, which you can see in the right-hand chart. I also talked earlier about how the sustainable transport theme was heavily impacted by supply chain headwinds, and APTIV is an example of that. In the first quarter, many car manufacturers had to stop production at European facilities due to the conflict, and that had a knock-on effect further up the supply chain. APTIV is a tier 1 supplier to OEMs, providing components used in electrification and automation of vehicles. Sales have been impacted as car makers have struggled with production delays, and the chart on the left-hand side shows the drivers of what goes into the company's 2022 revenue outlook. Part of that, which you see in the first box that's highlighted in red, depends on how fast the market grows. And that's clearly at risk with the current macro environment. However, a bigger component, which is also highlighted in red, the bigger box, is APTIV's growth over and above the rate of the market. The chart on the right shows that APTIV has consistently been able to deliver on that because of its focus on EVs and automation. And that positioning and that ability hasn't changed in this period. The near-term outlook is uncertain, and that naturally weighs on the stock price. But the company's market position and the role it plays in enabling the transition to EVs, combined with its track record of execution, gives us that confidence in the long term. Moving then to stock-specific attribution, there are a few individual stocks worth mentioning outside of those key thematic drivers. I have already mentioned cleaner energy as a positive theme in terms of performance, and that's reflected here through SolarEdge, which provides solar inverters and optimizers, and it had strong demand, it's seeing a strong demand environment. Claire will come back to that a bit more later on. LHC Group, which is a home health provider, was also strong following a takeover bid from United Health. On the negative side, HelloFresh was impacted by a few factors. The main one was that rotation away from growth and into value that we discussed earlier. But it did also announce higher than expected medium-term investment plans, which come at the expense of margins in the short term. We view the latter relatively positively because it enables them to capture the significant growth opportunity that they have. The market, however, took it more negatively because it was expecting margin expansion in the short term. Finally, ORPEA was a notable negative contributor, and it warrants a particular mention. ORPEA is an elderly care home provider, predominantly within Europe. With aging populations, the need for quality long-term care is clear. And with increasing prevalence of disease like dementia, ORPEA is addressing a critical need for some of the most vulnerable people in society. But care provision is labour-intensive, it's emotionally difficult work, and many countries have relatively low wages in that sector. ORPEA had been recognised as a leader in terms of quality of care, but an investigation by a journalist uncovered various failings by the company, as well as highlighting structural challenges within the sector. After engaging with the company, we took the decision to sell as a result of the uncertainty that came from those allegations and a subsequent investigation, but more broadly because of those structural challenges within the industry. We wrote about the issue in more detail in our quarterly report for those who'd like a bit more information. Finally, putting that all into some broader context, this next slide shows our long-term performance. And the underperformance over the quarter has had a knock-on effect on the longer-term numbers because of its magnitude. If you looked at this slide at the end of last year, you'd have seen our strategy having performed roughly in line with the benchmark over 5 years, despite not owning many of the strongest performers like Apple, which aren't part of our investment universe. Despite that performance gap emerging though, I would come back to the point I made at the outset, which is when we look at the portfolio, we don't see the current environment as undermining the thesis behind the strategy, despite the near-term headwinds for some of our companies. If anything, the supply chain issues and the renewed focus on the role of renewable energy have strengthened the need for sustainability solutions, which are long-term growth drivers for the companies we invest in. And importantly, we have found opportunities amidst the market weakness. The volatility, and particularly the weakness in growth and quality stocks, has created opportunities for us to either initiate new positions or add to existing high quality and impactful names. This quarter has seen higher levels of portfolio activity as we've sought to capitalize on those opportunities. Overall, we initiated 6 new positions and sold out of 7 existing holdings. These charts show the 3 key metrics, which are the changes in the 3 key metrics, which are the core building blocks of the strategy: quality, impact, and growth. There's a clear shift up in terms of operational quality as we've taken advantage of share price weakness to buy higher quality businesses, which had previously traded at higher multiples. Overall, the effect on the impact score was broadly neutral, but that was despite selling one of the highest scoring one of the companies with the highest impact score, ORPEA. So all of the initiations have had relatively strong impact scores to offset that. We've also significantly increased the growth prospects from an earnings point of view of the overall portfolio, as the style rotation away from growth has provided us opportunities to add to those types of companies. And I think a really key thing to note is that the price we paid in terms of multiples of those higher growth, higher quality, impactful names was overall the same as the ones that we sold. A good example to illustrate that is the addition of SPIRAX SARCO. SPIRAX is a UK company with over 100 years of experience in steam technology. It helps its industrial customers to use steam in various manufacturing processes more efficiently, which overall leads to CO2 savings. It's a company that the team has liked from a quality and a sustainability point of view for a very long time. Due to its business model, it managed to deliver very stable margins and high cash flow return on invested capital, despite operating in a very cyclical industrial sector. However, it has always traded at a significant premium. And while it's still not absolutely cheap, that premium did narrow to a level that we're comfortable with and we think is justified by its superior quality. Another good example of our initiations is TRANE. It's an energy-efficient air conditioner manufacturer, and it replaced an existing holding in the same industry, Lennox. We were impressed by TRANE's commitment to sustainability, and that's reflected in its higher impact and quality scores when you compare it with Lennox. It's got a target to reduce 1 gigaton of CO2 emissions from its customers' footprint by 2030, and that's a huge target. The compensation of its sales force is also linked to its 2030 ESG targets. TRANE is more focused on the commercial sector compared with Lennox, which is more focused on the residential sector. And we think the scope for impact is higher in commercial. Residential customers tend to buy the minimum efficiency that they need to buy. Commercial customers think much more about return on investment, and they can see the benefits of investing in improving efficiency of their systems. And so the potential for impact is higher, because customers are willing to pay for it. As well as new stocks, we've also added to existing holdings, and that's shifted even more the balance towards impact, quality, and growth over the quarter. Overall, we feel that this environment has enabled us to strengthen the portfolio position against our core focus areas. And despite the uncertainty in the short term, we're excited about the opportunities in the medium to long term, now more than ever. And with that, I'll hand over to Claire to talk about the investment opportunities in our cleaner energy theme.
As Adam mentioned, I'm a senior analyst with WHEB, been here getting on for 1.5 years now. And we're going to spend some time now just taking a closer look at the impact of the Russia-Ukraine war on global energy security and energy policy. So as you guys will probably know, Russia is one of the largest exporters of fossil fuels in the world. It's the second largest producer of natural gas and the third largest oil producer globally. In an attempt to put economic pressure on Russia, America has already banned imports of Russian oil and gas. Meanwhile, Russia has already cut off a couple of European states for its natural gas imports, and it's threatening to cut off all of Europe as well. And this is why energy prices are currently going through the roof. And Europe is Russia's biggest customer. It's buying around 50% of Russia's oil exports and about 75% of its natural gas. And as you can see on the right, Germany looks particularly vulnerable if Russia were to cut off those exports. IMK, a think tank, has predicted that if Russia cut off energy exports to Europe, it would send Germany into a deep recession. And this has all led the EU to realise that it's too dependent on Russia for its energy. So the EU has come out with a new policy, REPOWER EU, which is aimed at eliminating Europe's dependence on Russian gas by 2030. The plan includes provisions for more rooftop solar, heat pumps and investments in energy efficiency, a commitment to decarbonising industry through electrification and carbon reduction, and a commitment to speeding up renewables permitting. So far, the EU hasn't committed additional funding to building renewable energy capacity as part of this plan, although there's still plenty of funding already in existence from things like the EU Recovery and Resilience grants that came out of COVID. Instead, what the EU is doing is they're committed to speeding up the build of renewables capacity. So, as you can see from this chart from Wood Mackenzie, this will create a much steeper demand growth curve for renewable technologies such as solar energy. And you'll remember that one of the points in the REPOWER EU plan is to speed up renewables permitting. And you'd be forgiven for thinking that this is just a bit of red tape cutting. And to be honest, you'd be right. But in fact, the EU's wind sector is so wrapped up in red tape that it's seriously constricting new capacity builds. As you can see on the left, the permitting process in the EU is so slow and cumbersome that there is currently way more wind capacity currently in permitting stages than is under construction. So that's something that we really want to see reverse. Wind Europe, which is an industry association, felt that the permitting process was so bad that they've actually built some scenario analysis around it, which you can see on the right-hand side. So this chart shows their predictions for annual wind capacity build between now and 2026. In the low scenario, they're assuming that governments completely fail to address the issues in permitting altogether. And this scenario forecasts 13 gigawatts of wind capacity installed per year to 2026. In their realistic expectation scenario, they're assuming that governments deliver on the fairly modest commitments that they've already made. So, for example, Germany is committed to make 2% of its land available to onshore wind. Under that scenario, they're predicting about 18 gigawatts of annual wind capacity build a year. But this pales in comparison to the 32 gigawatts, which is required to meet the EU's target, which is for 40% of renewable energy capacity by 2030. So we've still got a massive shortfall, and we're hoping that the commitment as part of REPOWER EU to speed up renewables permitting will finally de-bottleneck Europe's wind industry. And even though the US is a massive producer of fossil fuels, it's still not been immune to the recent energy crisis. American energy prices have still gone through the roof, just like the rest of the world, because of what's happening in Russia and Ukraine. In response to Putin's price hike, the US has committed $3 billion for household efficiency upgrades, as well as new standards for energy efficient home appliances and equipment. And even before the war, America introduced the America Competes Act. And it's a pretty incendiary policy. It states that America has fallen behind in global science and innovation leadership, and the country must promote its economic strength. The policy pinpoints solar as a strategic industry and commits billions of dollars to domestic manufacturing. But these both come nowhere near the over $500 billion that was originally planned for renewable energy investments as part of the Build Back Better policy. That policy has unfortunately failed to pass the Senate. However, many of the companies and the consultants that we speak to believe that the cleaner energy funding will be reincarnated into a new energy security policy, particularly in light of what's currently happening in the world. Even Joe Manchin, the Democratic senator who practically blocked Build Back Better single-handedly, has come out and said that he would support that energy policy, although he has said that he wants it to contain provisions to support fossil fuel energy production as well. So it's not uncontentious. And what about the UK? So the UK recently announced its own energy security strategy. It's been a controversial one. A UCL, University College London, energy and climate professor was quoted in the FT as calling the strategy cowardly and incoherent. And that's because it includes nuclear, but excludes onshore wind, despite the fact that onshore wind is one of the lowest emitting sources of energy, as you can see on the left. And as the next slide will show, it's also one of the cheapest. So why is the UK excluding onshore wind? Our government basically believes that its voters find wind farms ugly and will say, you know, it sounds great, but just not in my backyard. But as the chart on the right shows, polls of UK voters show consistent support for onshore wind power across all three of our major political parties, even in voters' own local area. Meanwhile, this levelised cost of energy analysis clearly shows that solar and onshore wind cost about half as much as nuclear for energy generation. Also, nuclear plants can take about 10 years to build, whereas onshore wind and solar can be constructed in less than a year if only the permitting allowed it. Not only that, but spent nuclear fuel has to be specially treated and disposed of because it's hazardous. Typically, the waste gets stored in steel and cement casks before being formally treated. And as the map on the left shows, these casks are accumulating in America, which can't be good for the environment. And this entire process is costly. The UK estimates it costs us about $1.3 billion a year to get rid of our nuclear waste. And Stanford University estimates that an annual cost to America of about $5 billion. So just think what else we could be using that money for. So you can see why the UK's policy has been controversial. And obviously the Australia government has already banned nuclear energy. So perhaps you guys could pick up the phone to Boris Johnson and put him straight. So what are the solutions? Rooftop solar is a big one. It's quick and simple to build. It doesn't need any complicated permitting, and it's massively underpenetrated. In America, only 4% of houses have solar. So we expect our holding in Solar Edge to benefit hugely from the push for rooftop solar. At its recent Investor Day, the company unveiled their vision for our homes. Solar Edge is already the largest provider of solar inverters and power optimizers in the world. Now they're branching into batteries, EV chargers, and home devices such as water heaters and smart meters, all of which are intended to help their customers maximise the benefits of solar energy. And utility scale solar will also be crucial to decarbonising energy and reaching energy security. Our holding, First Solar, is an American manufacturer of solar modules. It can deliver made in America solar panels with hardly any exposure to China in its supply chain. So First Solar stands to benefit from various policies that are currently under discussion by the American government, which we talked about earlier. But the company is also ready to step up as America competes more actively with China on technology and innovation on the global stage. In wind, we're invested in Vestas Wind Systems, which is one of 3 leading global companies manufacturing and installing onshore and offshore wind turbines. Vestas turbines produced in 2021 will avoid over 500 million tonnes of carbon emissions over the course of their lifetimes. That's equivalent to nearly 100 million homes worth of electricity use for a year. So we're optimistic that simplified permitting rules and demand for energy security may provide a stronger and more consistent demand profile for wind technology, although this may still take some time to materialise. Finally, Power Integrations is a really cool company that manufactures energy-efficient semiconductors. A Stanford University study found that about 23% of energy in a Californian home is guzzled up by appliances being left in standby, like your TV or an air conditioning unit. So what Power Integrations has done is they've come up with a proprietary technology called EcoSmart, which basically gives a brain to an appliance. So it knows when it's on standby and can drop the amount of energy it takes from the wall outlet practically to zero. So this has enabled Power Integrations to save over 15 terawatt hours of standby energy on a cumulative basis, equivalent to about 6.5 million tonnes of carbon emissions just from this tiny little semiconductor chip. So hopefully you can see why we're really excited about the environment for cleaner energy and energy efficiency. We're continuing to do in-depth research into the space, and right now we're doing a deep dive on US installers of residential solar, and we're seeing increasing opportunities in this space, particularly in this very volatile market environment. And with that, I'll hand back to you, Victoria.
So just a few concluding remarks from me to wrap things up before we go into a Q&A. So at the end of 2022, we gave an outlook, and I think we were worried at the time that it was a little bit gloomy. But I think if this first quarter of the year is ending to go by, we were perhaps not quite gloomy enough. While we highlighted Russian belligerence about Ukraine, we didn't predict the invasion. We were worried about inflation, and we were right to be, but perhaps like many, we underestimated how high and how persistent it would be. Extreme weather from climate change was maybe an easier prediction. And the most recent IPCC report has made very clear that climate change is only going to get worse and we need to adapt. There has been some good news. Many countries are now finally emerging out of the cycle of COVID lockdowns. But China's current situation shows that we can't be complacent about that either. But if anything, I think we see that there are maybe more positive signs now than there were 3 or 4 months ago. The underlying quality and health of the businesses in the portfolio remains very strong. At a recent UK conference, Seb, our head of research, and I met a number of our companies, including Smurfit Kappa, Intertek, and SPIRAX SARCO. All 3 were very clear that despite the cost headwinds, they see themselves as being in a very strong competitive position with a positive outlook for the secular growth drivers underlying their businesses. And I think one of the real positives has been the current earnings seasons has shown that playing out in actual results. Hopefully, Claire has also shown that the Russian aggression in Ukraine could be a major tipping point and a catalyst to accelerate the shift to low carbon power sources, potentially with nuclear included, but undoubtedly focused on solar and wind. So as I said at the beginning, we are very alive to the changing dynamics that the first quarter has brought, and we believe the strategy is well placed to deliver positive impact and strong returns over the long term. So thank you, and I think that with that, we'll turn over to questions.
We have received a few questions already, and hopefully there will still be a few more that come in. But I'm going to start with one that I think is actually an excellent question. Given the range of current headwinds, have you tried to, or at least considered, reorientating the portfolio towards sectors that are more economically favourable at the moment?
Yeah, I mean, I think obviously in any environment, we have to take into account what are the short-term implications, what are the medium-term, and what are the long-term. And we did take a look at the portfolio and a look at the universe and tried to think about, what are the long-term ramifications of interest rates, of the potential for a sustained shift away from growth and into value, and what does that mean for the portfolio? And hopefully, as the presentation and as especially the stuff that Claire was talking about has highlighted, we've come away very positive about the long-term structural drivers for these businesses. I think we're cognizant that the headwinds could persist in the shorter term and remain a headwind for performance. But we are very focused on sustainability and on the solution side of things. And we think that will set us up well for the long term. And if anything, the case for those has strengthened. And I think within that, we looked at the universe. Were there areas where you could maybe shift more into value to protect yourself? But when you look at the sectors and you look at the opportunities in the universe, that those just aren't areas of the market that we have access to or would want access to. So energy was up 34% within the benchmark, driven by higher oil prices. That was the only real positive within the benchmark, and we just don't have exposure and structurally wouldn't want exposure to that. So it was a thought process we went through to be diligent and to make sure that we were thinking about all the possibilities. But I think we came away with a stronger view of the strategy and what we're trying to do, and also with the portfolio as how it stands at the moment.
I like that answer. Next question. Can you explain your approach to investing in raw materials like lithium and cobalt, as well as would you ever consider an investment in nuclear? It is a cleaner alternative.
If I perhaps take a stab at that one, Victoria can add anything if she wants to. So we've absolutely considered investing in raw materials that are crucial to the energy transition, like lithium, like cobalt. I think, though, the issue that we have with those companies is that they are basically operating in commodity markets, whereas our strategy tends to prefer companies that can deliver more structural growth, high quality growth. We look for companies that have, very strong competitive positions, maybe a unique technology or particularly strong customer relationships. And so we probably would prefer to invest in companies that are, have stronger competitive moats in that sense. We have looked at companies that are recycling raw materials. So we've looked at a company called Li-Cycle, which is recycling lithium. We've also looked at companies that are recycling plastic in new and novel ways. And that is an area that we might feel a bit more excited about. We think the impact there is a bit stronger, because they've got this technology. The competitive moats are a lot wider as well. So that's something that we might consider, but probably I'd say unlikely to invest in pure commodity stocks.
Briefly, nuclear?
Yes, of course. Sorry. So nuclear, we don't really invest in nuclear. Partly it is for the reasons I outlined earlier. It's not a great solution to the energy transition. I mean, uranium is not a renewable fuel for a start. It's finite. We have environmental issues to consider, not just in terms of the build-up of the costs I mentioned earlier, but there's also growing concern that the way in which we are treating and storing nuclear fuel, to keep it in a stable environment for hundreds of years, actually might not be as stable as we possibly believe, because a lot of it hasn't really been tested over that time frame. And there are some academics and scientists that think that is going to cause an environmental problem for the future. So we tend not to invest in nuclear for that reason. We also just, as I mentioned, think that renewable energy like solar and wind is just a better solution. Battery storage is obviously, so the reason that people think that nuclear is a great solution is that it allows a kind of base load power. But the issue with that is that nuclear power stations can't be powered up and down. They have to run at kind of a 90% capacity all the time. So it's not really appropriate as a base load power when you've got, solar and wind, where the amount of energy they are generating may fluctuate through the day. So battery storage is a much more appropriate complement, we think, to renewable energy, because that can be scaled up and down. And really, although it is more expensive than nuclear today, you know, we're still at the kind of beginning of the growth curve and capacity curve for batteries. So there's plenty of room still to invest in that capacity, bring the cost curve down, and really prioritise renewable energy and battery storage rather than investing in nuclear.
Great, thank you. Questions are now coming in thick and fast, so I'm going to ask that you keep your answers reasonably brief. First question, can you please explain the investment thesis behind HelloFresh?
Claire, do you want to take that one?
Yeah, I'll take that one. Yeah, I mean, I initially recommended HelloFresh, so I'm probably well placed to answer that question. Yeah, so HelloFresh is in our wellbeing theme. And the reason that we've put it in that theme, first of all, is because of the way that it encourages a healthy lifestyle. So HelloFresh meals are, you know, you're preparing fresh food at home. They are designed in-house by HelloFresh chefs, and they're designed to be nutritionally balanced. They are calorie and portion controlled. So I think the average calorie count of a HelloFresh meal is about 800 versus the UK, which is about 1,200 for an average supermarket bought meal, and the US is about 1,300. So they are controlling your diet, they're controlling your nutritional intake for those meals, and they're putting a huge emphasis on, you know, fresh cooking, low salt, low sugar, everything else. So that's why it's in our wellbeing theme. The interesting thing about HelloFresh as well is that because of the way in which they are essentially disrupting the food market by, you know, taking ingredients directly from farmers and delivering them straight to your door, they're also cutting out loads of steps in the supply chain, and in doing so, they create a lot less food waste than supermarkets as well. So that's another great thing about HelloFresh's supply chain. And in terms of the investment thesis, really, e-commerce penetration of the food market is still very, very low. It's still like probably low to mid single digits globally, despite the fact that food is the largest consumer market in the world. So we think there's ample room for disruption. HelloFresh is the first mover. It's the absolute monster in terms of scale in this market. You know, it's the only company to have a meaningful, not just meaningful, but number 1 and 2 competitive positions in multiple geographic markets. Whereas the other companies you might think of, like Marley Spoon, has, you know, a strong position in just one single market. So HelloFresh has huge scale, a huge advantage in that sense on the technology side as well, and it's also, we think, delivering very strong impact.
Thank you. Next question is somebody asking about you know, local Australian exposure. Are you only focused on offshore exposure, or would you consider Australian companies as well?
Well, we do actually have CSL in the portfolio, so there is some Australian representation there. We also initiated, I can't remember, was this quarter or end of previous, Fisher and Paykel, which is New Zealand, so still within the region. Unfortunately, because we tried to stay relatively neutral to the regional benchmarks, there's a limit to how much exposure within Asia we can have. But certainly there are a number of companies, I think, in the Australian market that are interesting and could compete for space within the portfolio.
Next question, can you quickly remind people about your approach to engagement?
Yeah, so engagement is a really core part of what we do at WHEB. So we aim to engage with all of our holdings. We vote actively, and that's a process that we're going through at the moment. We have our own sort of what we call red lines, where we set expectations for governance, and if the proposals don't meet that, we will vote against, and we will follow that up with a letter. But I think the more active engagement in terms of speaking to companies more directly is where we see real value. We've had some real success with that. We've had a number of engagements on biodiversity, so that was a kind of portfolio view that we took to try and look at the risks within the portfolio and see where we need to prioritize engagement. We also engage on more sort of one-off kind of bottom-up stock-specific things. ORPEA was unfortunately an unsuccessful example, but one where I think the engagement over the period did actually help us in terms of the decision that we needed to come to at the end of it. So really, really core part of what we do.
Next question, do you have any concerns about the future disposal of EV batteries?
Yeah, it's a great question. Absolutely. I mean, life cycle analysis is still, I guess, in development for EV batteries, and the recycling technology is still in development. As I mentioned earlier, we've been looking at companies that operate in recycling, and we've been looking at companies that can develop new and innovative ways to recycle EV batteries. I don't think we've identified any yet that are really making a meaningful contribution in that space, but absolutely, as we continue to invest in electric vehicle transition companies, this is something that we will consider. We don't currently invest in companies that are directly manufacturing EV batteries, so this isn't something that is kind of a direct engagement topic for the companies that we hold in the portfolio. But no, absolutely it is a concern. Absolutely it is something that we will continue to address.
Great. We've got a question here about precision fermentation. I'm not sure if that is familiar to you. I've just Googled it if it isn't.
I also just Googled it. So I think more broadly, if we think about alternative proteins and sustainable food supply chains, I think that's certainly something that we would be interested in as a solution addressing what is a major challenge and something we probably don't have a lot of exposure to in the portfolio currently. I think when we look at the technology that's out there, it's still pretty early stage, and that usually means that the companies are much earlier stage and probably fall below our minimum market cap, or the technology is quite a small part of a bigger business. So there might be areas where we have kind of indirect exposure, but it's not the core investment thesis for any of our holdings. But I think more broadly, one of the reasons we're excited about Trimble and what it brings to the portfolio, which was an addition in the most recent quarter, is exposure to more sustainable farming and agricultural practices. And again, that's something from a more broad climate perspective that we would like to add more of in the portfolio, because it addresses things like water stress, biodiversity, land degradation, more broadly than kind of the pure emissions savings, which a lot of the cleaner energy solutions address.
Thank you. Two more questions. Can you tell us about any future plans for businesses solving for health and social outcomes? I'm assuming, is there anything that you're particularly interested in at the moment?
Yeah, it's a great question. I mean, if we take health first of all, so that's obviously a huge investment universe for us. It's consistently an overweight in terms of the health sector relative to the benchmark. So loads of opportunities in healthcare. I guess one area that we think is particularly interesting is cell and gene therapies. So one thing that the kind of COVID vaccine, particularly the mRNA vaccine, has done, it has served as a proof point or proof of concept for mRNA vaccines and for other types of cell and gene therapy as well. And one thing that's come out of the pandemic is that we've got loads of life sciences companies, including companies in our portfolio like Thermo Fisher and Danaher, that have huge capacity now, which they can turn to new types of, for example, mRNA therapies. So combined COVID and flu vaccine, for example. So that's something that's really interesting and should be quite a growthy area. And we have also identified one or two companies that have pure play exposure to that area as well. So that's something that we are continuing to research. And then thinking about other social themes, I guess one thing that I would perhaps highlight, and another question which I've seen come in as well, on the education side. So we currently have one holding in education, which is Grand Canyon Education. It's been pretty resilient this year, actually. It's been one of our better performers year to date, mainly because people are expecting that, you know, with COVID kind of hopefully in the rearview mirror, we're going to start seeing students return to campuses, and it's going to, you know, really support enrollment growth and things like that after quite a tricky period. So we've got Grand Canyon in the portfolio. And then I guess an evolving theme or area in the education space is education technology. So how can we make education more accessible, cheaper, and more efficient, more effective for students, both young and adults as well? So that's something we've been looking into. We recently looked at a couple of companies that are providing OPM services, which essentially means that they are helping universities to take their existing courses online. We didn't find that those companies met our quality criteria, so we've not invested in those. But we have a number of other kind of education technology companies on our, I guess, to-do list in terms of, areas that we want to research, and that's something that is definitely ongoing and an area of interest for us.
Great. And very last question, what do you think about CSL at the moment?
Again, I think CSL is another one where there's kind of an interesting contrast between some of the short-term headwinds and the longer-term opportunities. So we're very cognizant of the cost inflation pressures that CSL faces in terms of plasma shortages, getting that back up to full volume, the labour inflation that they're seeing. But I think long-term, we still see the structural position of CSL is very strong, both in the plasma business and the flu business. Another area that people have sort of highlighted is, as Claire was mentioning with mRNA, is the risk of the flu vaccine there. So we're keeping an eye on data as it comes out from competitors, but it's not something at this stage that we see as a significant kind of material headwind in the medium term, and we think they have a very strong pipeline in the rest of the business. So overall, very positive. And the recent acquisition by Vifor, I think we're generally pretty positive on as an additional growth site.
Great, thank you. We don't have any more questions at the moment, but people listening, if you do have any further questions, please get in touch with us. We would love to hear from you. Thank you very much for joining us this afternoon. I hope that the team has managed to give some perspective about the current challenges and also to provide a basis for the optimism that we all really feel about the strategy over the longer term. Because to me, if I sort of consider things at the most basic level, it seems that the companies like these really need to succeed, because I don't think the alternative is anything we really want to think about at the moment or want to consider. Our next webinar in the series is with Amy Pham, the portfolio manager of the Pengana High Conviction Property Securities Fund. It's next Tuesday morning. You can register for that on our website. It's a very interesting strategy, also incorporates ESG in the full decision-making process. Thanks very much for joining us and have a good evening.